This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Individual investors are becoming a more powerful force. They're chasing momentum and increasingly levering their bets. Meanwhile, green shoots are emerging in less sexy areas of the market. Performance is quietly broadening. How to think of this confusing cocktail? Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Hope you're having a nice Independence Day weekend. Hope you're able to spend time with family and friends. Market is certainly not giving us a break, right? The volatility both at the index level, but certainly and even to a greater extent below the surface from sector to sector, industry group to industry group is accelerating. So we're going to talk about that. Pretty good first half of the year, even though June we saw a bit of a pullback in the S&P, mostly at the hands of the large tech stocks, the Magnificent Seven. We'll talk about that in a minute, but still, it was a good first half. If you're wondering what the precedent is for the second half when we've had this type of first half, well, Larry Adams here at Raymond James, he went back to 1950 and found that returns of at least 9% in the first half have been followed by returns on average of 8% in the second half, and in positive territory about 84% of the time. So, as I've said many times before, just because things are good doesn't mean they inevitably have to get bad, okay? Success often breeds success. And of course, past performance is no guarantee of future results, as I always say. But again, I think one thing I wanted to kind of explore a bit, and admittedly, I don't have any sweeping theme today. This is a little bit more of a potluck, a mixture of observations that I have on the current environment. But I keep remarking that, A, you've seen a lot more volatility than the headline averages would have you believe. A lot of shifting, sometimes violently shifting from sector to sector, industry to industry group within sectors. A lot of it seems to be sentiment driven. It's not necessarily triggered by a change in fundamentals, a big earnings release or a big macroeconomic data report. It just seems to be at times the whim of investors. And that's backed up by the fact that statistics are showing, at least the statistics that I've reviewed recently, that individual investors on Wall Street, they call them retail investors, have become a much bigger force in trading in recent times than they had been really in market history. We saw a certain period in COVID when everyone was sitting at home where individual investor volume picked up. And I certainly saw something like that during the dot-com bubble back in 1999 and early 2000. But historically, when you look over the last 50 years, there's been more individual investor volume and involvement than really we've ever seen. I read something from Citadel Securities this week. Just this first half of June, 9 of the 10 largest retail trading days ever observed on their platform happened the first half of this June. 9 of the 10. And then Friday, June 12th, marked the single largest day of retail net buying in their data set. And this is going back by like 40 years. Surpassed the previous record by 50%. You're also seeing the same thing in the options market. Explosion in daily option volume, up almost 20% year over year in June. And I will say a lot of that is zero-day options, which are probably the most speculative part of the options market. Okay, so the data doesn't lie. And where's it going? AI, right? 20 stocks in the S&P 500 have doubled this year, according to FactSet. 19 out of 20 are related to the AI infrastructure boom. You often see that type of narrow leadership when you have, a rise in speculative trading activity. What you've also seen, and I mentioned the dispersion between industry groups, you've seen an incredible spread between winners and losers. And I think it's certainly being exacerbated by this rise in kind of momentum trading, right? The spread between the top and bottom performing deciles in the technology sector, widest ever recorded. Again, this is FactSet data. Some of the worst performers are software. We've talked about that on previous podcasts. But the point I'm making is the dispersion is, I can use the word exacerbated, exaggerated, whatever you want to use. You're also even seeing it at the country level. South Korea stocks are up over 100% this year. China's stocks are down 12%. You almost never see that type of spread. And why is that? Well, South Korea is the home of some of the biggest memory chip companies in the world. China, that's not really the focus of their markets, or at least the concentration of their markets. Accompanying this, or maybe driving this, is a rise in leverage. You know, there's that famous quote from Charlie Munger, right? Warren Buffett's longtime right-hand man, who said, quote, "There are three ways for a smart person to go broke: liquor, ladies, and leverage." Let me be clear. Those are his words, not mine. I don't think I would have put it like that. But leverage is definitely a factor in kind of what we've seen, the rise in momentum, the rise in dispersion. I read this just the other day from the Korea Financial Investment Association. They found that the balance of margin loans on their local Korean exchange up 33% just since the beginning of the year. That's a huge leap in speculative fervor, right? The percentage of investors who've already maxed out their credit limits using stocks and bonds as collateral up like 12% over the same period of time. And it's not just Korea, seeing something very similar in Taiwan. And of course, you're seeing the same thing here. U.S. margin debt, what investors borrow from their brokerages to buy securities, according to FactSet, up 54% year over year. Now, here in the U.S., I don't know if it's as much of a systemic issue. I mean, if you look at margin debt as a percentage of S&P 500 market cap, it's still slightly below average, over the last 50 years. So it's not at levels where I'm alarmed, but the fact that the margin debt that is there appears to be concentrated in a small number of AI-related stocks. And again, South Korea, remember, their market, Taiwan as well, extremely concentrated. I talked about this a couple weeks ago, in a handful of chip names that are feeding the AI boom. Just makes me think there is a tremendous amount of leverage, again, chasing a small percentage of the market. Things can go the other way, right? Right now, it's a virtuous circle. It can turn into a vicious circle pretty quickly. So just be careful, and at the very least, expect volatility. I mean, a lot of these memory chip names are moving 10% in either direction in any given day, okay? That could get even more the case over the next 6 months of the year. It's not for the faint of heart. Be careful. I'm not saying don't do it or to do it. I'm not making a research call on this. I'm just saying be aware of what you own and be aware of that volatility. Meanwhile, I was reading something from Torsten Slok, who's the head economist or market strategist, at least at Apollo. He was saying the market is paying a premium for companies that lose money. And he specifically looked at the Russell 2000, the small cap index. Companies with negative earnings outperforming those with positive earnings by almost 25 percentage points this year. So again, you get my theme, right? Not only is the trading interest from retail investors concentrated in a small percentage of the market, it's in a speculative percentage of the market. And when this happens, right, out come things that attract investors. I read something, probably familiar with the Bitcoin Treasury Company, used to be called MicroStrategy, run by Michael Saylor. And I'm not picking on him or their company. I don't really have any opinion on his company at all. But I was just interested to see that they came out with earlier this year a preferred stock offering that, quote, according to him, this is his words, delivers money market-like stability with market-leading risk-adjusted returns, end quote. Okay? Well, here we are, early July. It's experienced a 16% drawdown this year. And when I read this last week, it was down 8% for the year. Bottom line, folks, money market-like stability and market leading in returns should never be, in my opinion, mentioned in the same sentence, right? There's no such thing as a free lunch. But this is the kind of stuff that comes out when people believe in the infallibility of kind of the risk trade, right? Same thing in the IPO market, initial public offering market. I talked about SpaceX a couple weeks ago. Again, I'm not making a comment on whether SpaceX is a good or bad investment, but I am, I think allowed to tell you about sort of the context of IPOs. And the reality is, according to my math, pretty much every major IPO in the last 15 years, at least what I would classify as major, and you can think of the names as well as I can. Palantir, Airbnb, Snowflake, Spotify, DoorDash, Meta, right? Coinbase, Uber, Rivian, Alibaba, Twitter. Okay, I could go on. But if you look at the list, every company that's gone public, pretty much every single one of them was below their first day close at some point during the first year. Every single one of those names. Okay, so I'm just saying this because there's been a lot of talk, right, about bubbles. I'm not sure that we're in a bubble, and nobody is sure, by the way, that we're in a bubble. And no one's going to know that until looking back at things in retrospect. But there is certainly speculative activity, speculative fervor in pockets of the market that you have to be, and it will have an effect on the overall average. I mean, if you look at the semiconductor index, I want to say 2 years ago, I don't have the exact statistics in front of me, but semiconductor index was about 5 or 6% of the S&P. Today, almost 25% of the S&P. So when you get this type of volatility, even in a small pocket of the market, it will affect the broad market, okay? And I think that just the other thing to keep in mind is it's very difficult to know how all this is going to play out, right? There's a famous quote from Steve Jobs that I've actually kept in my desk, and I'll just read it to you. Quote, "You can't connect the dots looking forward. You can only connect them looking backwards. So you have to trust that the dots will somehow connect in the future." Okay, what does that mean? You don't know how companies are going to adapt to changing situation. And in fact, Apple's the kind of the poster child for that, right? Remember, they spent 30 years trying to compete in the corporate desktop world and basically failed. They basically lost that battle. But then they pivoted towards adding functions to MP3 players, and that was, of course, the precursor to the iPhone, and the rest is history. I say all this because to justify current valuations in a lot of pockets of the market currently, you have to be confident in revenues and earnings literally, in some cases, I know I'm generalizing, but in some cases a decade from now. And that is virtually impossible. We have no idea certainly what any industry is going to look like in 10 years, although I think I'm a little more confident in some areas than others. But certainly anything to do with technology. I mean, 10 years ago, people didn't even know what AI was. Most people, right? Unless you watched the Terminator movies. I'm only half joking. But going back to the bubble thing, people are very comfortable thinking that they can call the tops. And what have we seen recently? Like we always see, a proliferation of famous hedge managers making market calls. And I'm not, trying to pick on anybody because Lord knows these people are much more successful than me, or at least have been historically. But like Ray Dalio is famous for this. So is Jeremy Grantham, right? I've gotten forwards from multiple clients in the past 2 weeks with market calls saying we should, get out of the market, that we're on the precipice of a bubble from both of these guys. That's why I bring it up. But I went back and read a piece from Ritzold Asset Management. Ben Carlson up there. He produced 7 different articles, I want to say, from Ray Dalio predicting a complete blow up in the market and the economy. So I'm looking at Dalio. One was just recently, September of 23, January of 2019, October of 22, January of 2016, October of 2012. So that's in the last 14 years, I should say. There are a couple more. So I think it was like 7 times he predicted a collapse. Jeremy Grantham, something very similar. At least 5 market collapse predictions in the last 7 or 8 years. The only reason I bring this up is just because these guys have made a lot of money doesn't mean they know any more about the future than you. That's what I have found. I've been doing this, what year is this? About 34 years? 34 years almost? I have never met anyone who has successfully predicted market tops and bottoms. I've seen people get it right once, and they've kind of hung their hat on that and made their career on that, but then they were never able to predict that again. So maybe somebody got lucky one time, but it doesn't mean they've been able to recreate that success. So don't even pay attention to those articles would be my advice. I don't think it makes sense. I mean, I'm not saying don't pay attention to risk. I'm obviously not saying that. But to think that somebody can pinpoint when something is going to happen, forget it. But the other thing that's kind of going on, even in the midst of some of the speculative activity that has dominated the market. So up until about 2 weeks ago, according to Apollo, if you stripped out AI and stripped out energy, which of course got a nice bump during the Iran situation, the rest of the S&P was down. The S&P was actually negative as of 2 weeks ago for the year if you stripped out those pockets of the market. Even within the NASDAQ, if you strip technology out of the NASDAQ's been basically unchanged for 3 quarters. So the rest of the NASDAQ names have done nothing. However, just in the last 2-3 weeks, we've started quietly to see the worm turn, and I think this is really important. Both the S&P 500 equal weight, which is, remember, that's the 500 stocks in the S&P weighted equally instead of by market cap, and the advanced decline number, which is the ratio of advancing stocks to declining stocks. Both have been breaking out to new all-time highs. Okay? What is that a referendum on? Market breadth, more companies participating. Remember this time last year, actually a little bit before this time last year, so like February, March, April of last year, breadth had been diverging negatively for months, ultimately resulted in, when the tariff news came out, a correction at the index level as well. Kind of the opposite conditions this time around. Breadth is actually improving. More than half of the S&P, according to Grant Hawkridge, he's a trader that I follow, more than half of the S&P is in an uptrend by his math. And again, it's without the participation of the Magnificent Seven. First half of the year, the Magnificent Seven collectively, in aggregate, negative performance. So it's the other 493 names that are, kind of picking up the baton, so to speak. I think healthcare is particularly interesting. The equal weight biotech index is going to be, I guess, finished June, according to FactSet, its highest monthly close ever. Okay? Keep in mind, and I said this actually repeatedly over the last 6 months, healthcare had been the worst performing sector in the S&P. If we were talking a month ago, maybe even as recently as 3 weeks ago, the healthcare index was underperforming the S&P 500 by almost 17 percentage points. Huge spread. One of the worst underperformance periods ever recorded, at least in the last 3 or 4 decades, right? And healthcare, by the way, is still lagging the S&P, but the gap has narrowed significantly. And I will tell you, it's backed up a bit by expectations for fundamentals. I was reading FactSet estimates for the next quarter. Healthcare for 2027, so forward-looking estimates, healthcare space is supposed to have almost 18 or 19% earnings growth versus the current 3%. So it's being backed up by some positive revisions in actual fundamentals. And there's some other tailwinds as well. I mean, if you look at managed healthcare, really starting to see the benefits of AI, okay? AI improving processes, improving back office operations, and according to Axios, this year we're on track for $560 billion to be spent on prescription medications. That's up 8.2% according to them over 2025. So despite, Kennedy's push to, get people off of prescription medication in many cases. I know I'm generalizing, but you're seeing the populace go the other way. GLP drugs, of course, are leading the charge there. Something like 1 in 5 adults have taken a GLP-1 drug at some point in their lives, believe it or not. So healthcare is interesting. So because it's almost like it's a win-win for now, because you have the positive fundamental momentum, both sales and earnings, but also there's some defensive qualities if people are looking some diversification away from tech. So that's kind of where we are. We're in this kind of interesting confluence of speculation around AI, but underneath the surface, some rotation into other areas of the market. What does it mean for us as kind of rational individual investors? Well, the obvious thing is, keep some balance in your portfolio. I don't mean to be Captain Obvious here, but diversification matters, and you don't know when those inflection points are. There was no real trigger for healthcare suddenly doing better, other than maybe that's where money has gone that's come out of Magnificent Seven. Maybe that's one explanation, or maybe it's just, wait, these things got too cheap. I don't know. But when you have a market that is sentiment driven, as I mentioned earlier in this podcast, more retail investor interest driven, you can get these types of shifts. You just don't know when they're going to come. And again, I want to make sure everyone is aware that when you have this much momentum and this much leverage in the system, the quote unquote hot sectors can go through, even if they end up being huge winners 5 years from now, can go through periods of pretty violent corrections. Just be aware of that. Just to change gears for a second, I don't have too much to say on kind of the economy or the macro picture, other than to say that I think inflation and the Fed's response to inflation is going to be probably one of the 3 or 4 main kind of drivers, at least of sentiment, market sentiment, over the course of the next 6 to 12 months. The new Fed chair, Kevin Warsh, he was pretty unambiguous, right? He basically came out and said that, in fact, he used those words. He said, quote, "The commitment to deliver on reducing inflation is strong, unanimous, and unambiguous," end quote. Those are from Warsh. So we know where he's coming from. And we also know that if you look at the bond market, like the 2-year Treasury is a pretty good referendum on where the market thinks the Fed's going to be. Market's pricing in a couple of Fed hikes, not cuts, Fed hikes over the course of the next 12 months, which is a pretty big swing in expectations from where we were, in January. But what I thought was interesting, though, there's some other pockets of the bond market sending different signals. If you look at Treasury inflation-protected securities, better known as TIPS, and what they're pricing in, as well as the swaps market, they're pricing in inflation closer to 2%, an actual drop in inflation. So you have some market activity sending different messages about whether the Fed should be hiking or where the ultimate inflation rate should be. We all know that oil prices have come down in the last few weeks. They were up over $100 a barrel at one point. Now, as of this recording, they're below 70. Okay? That will certainly help inflation, as will the rolling off of tariffs, declining housing inflation. Those are all things that should limit inflation. But on the flip side, and Kevin Warsh hinted at this, there are inflation pressures in the system beyond oil. In fact, even oil itself, counterintuitively, could be, kind of an inflation signal, right? Because lower oil prices may mean more demand in an already overheating economy, which could mean higher inflation. There's certainly people looking at it that way. But what we're also seeing is AI ultimately may be deflationary, okay, because it can enhance productivity and bring down prices, maybe bring down labor costs, but at least in the short term, it's inflationary, right? These companies that are selling chips at inflated prices, like the Microns of the world, that is really starting to filter through the food chain. And just recently, just this week, Apple announced, and I think Microsoft did too with respect to Xbox, but certainly Apple announced they're going to have to raise the prices on their MacBooks and their laptops, in some cases by over $200. because of the costs that they have to incur to, the nuts and bolts of those products. So again, who knows what happens 2, 3, 5, 10 years from now, but in the short term, AI is inflationary, not deflationary. So what do you do about it? Well, part of it is, if you can't beat them, join them. In other words, maybe buying some of these companies that are able to absorb costs and pass along those costs makes sense, right? And again, this is not a research call. It's just a reality that if you look at, this is from FactSet, if you look at S&P 500 sales and inflation, those two charts over the past 20 years, they're almost in lockstep. So as we've gotten inflation spikes, so have sales spiked, which means that companies are hiking their prices, and we as consumers are accepting those prices. We're paying those prices, like it or not. I've said this before. I was at Dulles Airport a week ago. Place was jam-packed, despite, fares, travel fares, airline fares, much higher than they were a couple years ago, right? We're paying the prices, like it or not. So what is bad for consumers is not necessarily bad for corporate America, at least for now. If you go into a recession and demand dries up, that's a different story, but that's not the current situation. So that's one thing, and that's kind of borne out historically. So, Creative Planning came out this week, and they looked at the last 30 years and how the purchasing power of the U.S. consumer dollar has been cut in half, according to them. Cut in half due to inflation. At the same time, the S&P has gained 852%, almost 8% a year after inflation. So I think you get the message, right? You get the message. The message is that, this is obviously not a short-term market call, right? Anything can happen in the short term, but over an extended period of time, stocks have still been the best investment in the face of inflation. And the last thing I'll say on inflation is, if you think that assets like cryptocurrency and precious metals are inflation hedges, I don't know. Recent market action would say that's not the case, right? Cryptocurrency is in the midst of almost a 60% drawdown from the highs. Gold, after being up over 20% at one point this year, now down about 8% for the year. Silver, it's worse. So again, maybe it's just a correction and an upward trend, but those people that own those things for inflation protection, I would say that those prices are driven by other factors. Maybe it's the dollar, maybe it's interest rates, maybe it's expectations about our government debt and what the monetary and fiscal policy are going to do about it. I don't know. Probably a confluence of those things. But to say that the cryptos and metals are inflation hedges, I just don't think that's borne out by the data. So just keep that in mind. All right. Could take a quick break. When I get back, I do want to comment briefly on kind of what we're seeing in the individual stock space. We'll have a lot more in the next few weeks. Of course, the second quarter just ended. We'll start to get second quarter earnings over the next 2-3 weeks, so we can talk more specifically. But I did have a couple thoughts I just wanted to share. Back in a sec. Violent stock market rotation, growing divide between winners and losers, and AI disruption fears. But might one man's trash be another's treasure, with opportunities emerging amid the churn? Tune in every week as we discuss the latest financial trends and what investors need to know to learn where to find value in a frenetic market and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James and Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Do have a few thoughts on some individual securities, more observations than anything else. Just remember, the names I'm going to mention are names that we own in many of our client portfolios, and I do own personally in my own portfolio, which is a conflict of interest. So consider that. Also, if you're using this podcast to kind of inform your investment decision making, make sure you do your own homework, do your own research. These are not research opinions. Just keep that in mind. So we talked a lot about, the concentration in AI-related names. But what's interesting is, and I read a really good article on this, article called The Memory Tax by Emil Schillingerin. Read this author several times in the past, but really good article about kind of the evolution of the AI trade. And I think we all know it kind of started in earnest with sort of the hyperscalers, the spenders, the companies who were spending big on AI build-out, right? We all know the names, Microsoft, Google, Amazon, right? They were the market leaders. That has dissipated in recent months. Okay, now I'm not saying it's gone forever. Those stocks could end up returning to leadership position at some point. But for now, they have ceded their leadership to the companies that are supplying them, the chip companies, specifically memory chips. Okay, so just to drill down that on kind of the history of memory chips a little bit. And remember, these memory chips, a lot of them are made in Korea. That's why the Korean market has done so well. Market performance has really been driven by a handful of those names. Back in the day, the point that this article is making is that in previous cycles, this has been a very cyclical market where it hasn't ended well for these companies. And if you look at a long-term chart of a company like Micron Technology, for example, I'm just using that as an example, they've had some huge rallies, but also some huge drawdowns, like significant drawdowns over the course of the last, 30, 40 years. The iron law of business used to be, quoting from this article, was that the buyer held the whip. End quote. Companies like Apple and Dell, they could pit suppliers against each other and kind of pay accordingly. That kind of changed when a single class of buyer emerged, this single kind of hyperscaler class, right? The Googles, the Microsofts, the NVIDIAs of the world. This is a group that apparently will absorb the entire supply of chips at almost any price. So the memory chip guys, they don't have to court anyone anymore. They can basically, take advantage of that. And as a result, we're seeing literally contract prices for some of these memory chips up 100% in the first quarter, year over year. Literally. Prices, so they have complete pricing power. And they're basically signing these contracts where buyers are now pre-funding the factories. They're signing contracts engineered to guarantee the supplier's profit through the next downturn before the next downturns even arrived. So they are so desperate for supply from these chip companies. The chip companies are in an incredible position at this point. Meanwhile, who's the victim? Well, we're kind of the victim, right, as consumers. And this is kind of what I was saying with the Apple, price hikes. Because these hyperscalers are taking down all the supply, there's no supply left for a lot of the consumer goods that we buy, including MacBooks and laptops and things like that. That buying class has much deeper pockets than the consumer class. So it's a very interesting situation. And, again, if you look at the history of it, eventually, supply will catch up. And when supply catches up, we could easily see a drop in the 85, 90% profit margins that these companies have. So that's the risk of, I think, the memory chip names at this point. But the other thing I just wanted to bring up is if you're looking at where the bottlenecks are, that's kind of the current bottleneck. So much demand for these chips, too little supply, okay? Where's the next bottleneck? Well, what this article suggests, and I agree with, it's electricity. It's power. And it's not as glamorous as the chip business, but there is a significant shortage of electricity. I mean, Gartner, the consulting group, they expect power shortages to throttle 40% of AI data centers by 2027. Interconnection queues run for years. A high voltage transformer can take longer to procure than the actual building that it's going to feed. So that's where there's an incredible bottleneck. So again, I bring all this up because it's important as an investor to be forward-looking, not backward-looking. I'm not making any comment on the merits of hyperscalers or chips because a lot of the success or failure with these companies is also going to come down to valuation. A lot of it's going to come down to when you buy these investments, at what price, right? At what valuation. But the important takeaway for me is looking forward to what will be the case over the next few years, and that power shortage. So I've mentioned, GE Vernova. I've mentioned Eaton Corporation, Vistra. These are names that we have added into many of our client portfolios, and as I mentioned earlier, I've added personally, that occupy kind of various pockets of that food chain, if you will. That power food chain. So at the very least, I think you should be taking a look at the space, right? Of course, what are the risks? Well, the risks are some of these stocks have already moved a lot already. You've got to pay attention to valuation. And of course, if there is a major fallout in capital spending, right, actual build out because of these risks, either companies run out of money to fund the build out or they just decide the economics aren't good enough anymore. That will be a significant risk as well. But that strikes me as the next bottleneck. So I'll leave it there. Just to change gears a little bit, I read another article, and I said at the top, full disclosure, this was more kind of observations than actual stock specifics. But I've been doing a lot of reading recently, and there was an interesting article that caught my eye from Robert Armstrong, called What is the Point of Berkshire Hathaway? Which I found interesting because we've owned, you long-term listeners know that we've been at least owners of Berkshire Hathaway for many clients for a pretty long period of time. I've always thought that having some money invested with Warren Buffett was more often than not a good idea. But what the article talks about is, well, if you actually look at the reality of it, what kind of space should Berkshire Hathaway occupy in a portfolio? And it made the point that it's been a long time since Berkshire Hathaway was a significant outperformer of the S&P 500. He said if you compare the rolling 10-year total returns on Berkshire with the S&P 500, the last 10-year rolling period in which Berkshire consistently beat the index ended way back in 2012. Since then, the two kind of pass the lead back and forth. S&P outperforms when animal spirits are strong, like they are now. Berkshire doing a bit better when sentiment is weak, like April of last year, when the tariffs came out. And it's been kind of a draw over the past 14 years. And he goes on to say that, hey, listen, if you think of Berkshire as a no-fee, low volatility, tax-efficient mutual fund that may underperform the S&P sometimes, but also outperform in periods of stress, maybe that's not such a bad way to think about it and a bad investment to hold. But he also makes the point that, you've got to look at it maybe a little bit more soberly. And he says, well, listen, Berkshire recently has traded more in line with property casualty insurance stocks and has actually tracked that index pretty faithfully. So that's not how a lot of people think about Berkshire, right? People think about it as Apple being their biggest holding, right? Or an energy company or a conglomerate. But it's actually tracked insurance stocks probably more than anything else. He also said that maybe people should question Berkshire's ability to outperform in times of market dislocations. In fact, he looked at the 10 years that started in 2007, right before the financial crisis, and found that Berkshire did not outperform the S&P over those 10 years. So whatever advantages they may have had, in terms of having a ton of cash going into a big correction or sell-off, didn't really translate into future performance. And finally, what he concludes here, and I'm bringing all this up, by the way, just to present kind of an alternative view of Berkshire. People think of it as an untouchable investment, and he's basically saying, well, listen, you need to think about it in a little bit more sober. Don't look at it through rose-colored glasses anymore, particularly with Buffett gone. And he was just suggesting that what Berkshire should be doing is a couple things. One is act more aggressively on their convictions. He points to the Apple trade that, they made Apple the biggest position basically at the right time when the stock had gone through a correction and it's been a huge winner. He wants more moves like that. He wants Greg Abel, the new CEO, to be bolder. He also wants them to take advantage of the fact that they have access to cheap capital. They can basically be a business builder as well as a business buyer and manager, essentially a private equity fund, but with an infinite time horizon, and they need to leverage that cost of capital more. So again, I just bring this up because most of what you read about Berkshire is kind of, it's an untouchable stock. Everybody's got to own it. But I think if you actually think of it through the lens of authors like this, it's helpful. It's helpful to think about that. And again, the other takeaway may be what I said a minute ago, that listen, if they are indeed going to outperform, maybe not always, but as they have historically in times of market angst or stress, it's a worthwhile investment. So anyway, think about it that way. The last thing I just wanted to bring up, just have a couple more minutes here. Doing a lot of reading on Costco recently, and I've talked about Costco many times over the past several years. I think the biggest risk factor of Costco, full disclosure, is that it's an expensive stock. It's traded upwards of 50 times earnings at several points over the last couple years. But I think it's one of those cases where you really need to understand kind of the story behind the stock price. And I've been doing a lot of reading on their Kirkland brand, which is kind of their house brand, right? You've been into Costco, you know all the Kirkland products. There's a lot I didn't know about Kirkland that I probably should have known, if I'm being honest. One is that according to my reading, and again, I'll give credit to another article, Trung Phan, who wrote this piece about sort of the history of the Kirkland empire. One is you may not realize how big Kirkland is. As of 2025, it hit $90 billion in sales. That's bigger than Boeing, FedEx, T-Mobile, Wells Fargo, and Procter & Gamble. Kirkland does more business than all of those stocks, or all those companies, I should say. Pretty unbelievable. But if you drill deeper into what they do, first off, the way they approach it is all these retailers are desperate to get on Costco's shelves just because of the amount of business that Costco does. So that gives Costco a tremendous amount of leverage in negotiations. And the short story, I could go on forever, but the short story behind Kirkland is for every product SKU, okay, and a SKU just means a product. So let's say detergent or toilet paper, whatever it is, they're generally going to have two products. They're going to have a name brand and they're going to have a Kirkland brand. Some exceptions, but that's kind of the Costco model. So if somebody wants to get into Costco, so let's say that Procter & Gamble they're already in, but let's say they want to get in to Costco. Costco says, okay, well, here's what you're going to do. You can sell your flagship, Procter & Gamble product at whatever price you want to sell it for, but then you're also going to make a product that we can post under the Kirkland brand. And here are our criteria. One, we're going to put limits on how much you can make from it. So in a regular grocery store, your margin might be 20, 25%. Here, it's going to be 6 or 7%. You're going to eat profit on this if you want to be on our shelves. Secondly, the product has to be at least 1% better in quality, whether that's taste or whatever it is, than your flagship. That's their criteria, and they literally, disseminate that criteria. And the reason that companies go along with this is because of the volume. So the Procter & Gamble's of the world, the Starbucks of the world, all these companies that are on the Costco shelves, they are willing to take less profit on that good, that product, that SKU, because they're going to have tremendous top-line sales, just from Costco's scope. So it's an incredible business model because what is Costco doing? They are passing along those savings to customers, but they're not offering crap. The Kirkland brand is a superior brand, often better than the name brand. So I just wanted to bring that up because I don't think a lot of people properly understand that and how that works and how it allows Costco to keep pricing level but quality high. Usually those things do not exist at the same time, right? I remember the old, traditional generic goods. I used to go to, Giant when I was a kid, and it would literally be, a lot of us grew up with, Giant brand grape soda or Giant brand orange soda. Tasted like garbage, right? The quality wasn't there. But Costco's been able to pull that off. So this is a company that is willing to pass along price to their customers, but still keep high profit margins. And that's how, remember, a lot of the profit that Costco makes is through membership. And they have over 90% retention. Over 90% retention. And they also are able to, the way that they lay out their stores, about 2/3 of their sales, I think, come from Kirkland. But then they also allow a certain section of the store for kind of treasure hunting, right? They pushed a lot of the traditional kind of staple stuff that people go in for, the toilet papers, the paper towels, the cereal, all that kind of stuff, to the back of the store. To get to the back of the store, you have to go through the treasure hunt, right? The clothes, the things that are in the middle that are kind of drawing people in. In fact, a lot of Costco shoppers, they pride themselves on that. Like, what kind of deals can I find in that kind of middle of the store before I do my regular shopping? That's why you walk into Costco saying you're going to buy some detergent, $300 later you walk out. That's what happens to me. I've never gotten out of Costco for less than $200 or $300. So what does this mean for the stock price? I'm not really making a stock call here. I referenced the fact that you're paying, around 50 times earnings, but I do think it is important to understand that model, that Kirkland model, because that's what drives the loyalty, the stickiness of their membership, and I think makes Costco the type of company that can perform in a wide variety of economic environments. Good markets, bad markets, high gas prices, low gas prices. We saw that a few months ago when gas prices, or less than 3 months ago, when gas prices spiked up as a result of the war. Costco's stock did fine. Why? Because their cheap gas was bringing people in. Those people were getting gas and then going into the store and spending a few $100s, right? So Costco has historically been kind of an all-weather stock for that reason. But consider the valuation, because a lot of those benefits, are already discounted in the price. So you really have to be careful. So anyway, I know this is a little unorthodox. I didn't get too granular on, earnings and sales and what have you. But I thought kind of a bigger, more 10,000-foot view of Berkshire, Costco, and then maybe some of the AI-related transition potentially from hyperscalers to chips to maybe energy names over the next couple of years is worth understanding and thinking about. Hope that was helpful. As mentioned, enjoy the rest of your July 4th weekend. And until next time, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.